Thanks, everybody. Appreciate being here. Yes, I come once a year just because that's about as much tax stuff as I think you can all handle. So it gives you a year to get it out of your system before I come back. I'm going to give you the skinny on taxes and really how to get fat on IRS-approved tax loopholes. You realize that for business owners, there are just shy of about 500 tax deductions, legal tax deductions that you can take as a business owner. So I would submit to you, don't try and go make the next one. Usually the IRS will come down on that. There's plenty of them out there. You just got to know which ones they are. I picked out the ones that I think are the most relevant to investors. I've been an investor myself. I've been part of the solid real estate since 2003. And I've learned a lot. So I understand kind of where you're coming from. I've got a lot of clients who have come from this group. So I understand those who are doing lease options, those who are doing rentals. I understand those who are doing flips and all that other stuff. So anyway, we'll go on to the next slide. Just so you know, tax preparation is not tax planning. And so what's the difference between the two? For me, tax preparation is between January and May time frame. Tax planning needs to happen before the end of the year. And so I have a lot of clients that will come to me and they say, all right, here's all my stuff. How can I save money? And it's like, well, December 31st is already come and gone. Most of your options are gone. Okay? And so if you're going to do tax planning, that needs to happen prior to the end of the tax year. Tax preparation starts after that. So that's the difference there. All right. Just so you know, just so you're aware of a couple of the expiring tax laws. R&D tax credit, sales tax exclusion for forgiven debt on primary residence. That's a big one for a lot of people, the 1099-Cs. Tax-free IRA distributions to charities, energy efficient home, house reimbursement accounts. They haven't gone away, but they're more severely limited with what they can do now. That just kind of gives you a flavor. Also, we are talking about Congress that just didn't get around to it, so it's likely that some or maybe all of these will, be retroactively reinstated sometime this year. Could even happen next year to reinstate for this year, knowing Congress. So, all right. So that's just some of the expired tax breaks, just for your information. Again, gone, but maybe not forgotten. New tax rules for 2014. Three of the big ones are healthcare reform, standard mileage rate, and home office fee. I'll go through them one at a time. First off, we got healthcare reform. First off, we got individuals without qualifying insurance owe tax. The key word there is qualifying. A lot of people have some type of insurance. A lot, you've heard in the news, people that have had policy cancellations, because these policies do not qualify. There's certain ramifications for qualifying. What is the tax if you don't have this type of insurance? First off, there's two different ones. There's the basic penalty and the income-based penalty. The basic penalty is $95 for those 18 years and older, $47.50 for anybody under, up to $200 and what's my number there? Oh, I forgot to put it on. Anyway, up to basically works out to two individuals or two adults and two children. Like $285 or something like that is the most that you'll pay on that. Or you can do the income-based levy, which is 1% of your AGI minus the minimum AGI that's required to actually file the return. So for singles, that's $10,150. Couples is $2,300 plus an additional $3,950 for each dependent. So if you kind of figure that out, if your AGI is $50,000 and you're just you and your spouse, $20,300. The difference there is about $30,000. 1% of that is. I carry my decimals. 300 for the two of you. And there's no upper limit to that. But as 2015 and 16, those percentages will be more. So that's something to look forward to. There is a bit of ray of sunshine. The IRS cannot levy or lien if you owe that tax. They also cannot charge interest if there's a balance on that. The only thing they can really go after is if you have a refund coming to you, they can offset it with the refund. So there's a lot of teeth in some parts of the bill. That part of the bill, there's not a whole lot. Okay. Real quickly, the standard mileage rates this year, 56 for business miles. That's down half a cent. Medical miles and moving miles, 23.5. Charitable miles stay at 14.
What's charitable miles? Like home teaching?
Charitable miles.
Dude, I need to start doing that.
Your bishop's going to ask you to tithe 25%.
I need an assistant scout.
Exactly. Anything having to do with that, going up to scout camps, or if you're not reimbursed for it. If you're reimbursed for those miles, that's your deduction, basically. If you do take the standard mileage deduction, you still can take tolls and parking. The other option to standard mileage is actual expenses. Okay. If you're in an S corporation, you must do actual expenses. LLCs have the option, and sole proprietors have the option to do standard mileage. But still, even if you do the actual expenses, you still have to keep track of your mileage, because you've got to figure out at the end of the year what that proration is between your business and total mileage. So if you end up using your car, 80% of the time, then you go out all of your actual miles, all of your actual expenses, gas, oil, repairs, all that type of thing, and then you times that by the 80% to get your deduction.
So if you just keep track of your business miles, and you know what your beginning mileage was for the year and ending mileage for the year, then you can do the expenses.
Yes, exactly. Yes.
Is that easy for the S corp to do actual expenses?
That's always been the case. You cannot take standard mileage deduction on an S corporation. The question was, has it always been the case that on an S corporation you have to do actual miles and not standard deduction or standard mileage rate? That is true. It's always been that way. So sole proprietors and LLCs are the only ones that can use standard deduction. It's interesting talking about mileage. I get some of my clients. They'll come in and I'll say, "So what's your mileage for last year?" Oh, let's say 15,000. Really? You want me to put 15,000 down on your return? IRS agents may not be the smartest tools in the shed, but they're smarter than that. At least give me 14,953. Then I think you're telling me the truth, and they'll think you're telling me the truth. Okay? So just word to the wise. Or not so wise, as the case may be. All right, let's go to the next slide. Home office deduction. In the past, you had to figure out all of your home expenses. The big ones being utilities, your hazard insurance, those types of things are pretty much the big things that you take on home office expense. Obviously, you figure out also the percentage of your home office square footage versus your entire home square footage. You get that percentage, and you're able to do that. They've come out in 2000 and help to basically give you kind of like a standard square footage deduction for your home office. Now you can do $5 per square foot up to 300 square feet. Okay? Now, that doesn't mean you take a $1,500 deduction if you only have a 120 square foot home office. Obviously, but you will get the $5, but you don't have to come up with all the other stuff. I had people that would, for, 3 days, get together all their utilities and figure all this stuff out. And then, they had a really small office, and so by the time you figured out what their home office deduction was, it was like maybe $200 or $300. And then they were only in the 10% tax bracket, so it really only saved them $20 to $30 of taxes, and they spent 3 days doing it. Well, obviously, this is going to help people out. I mean, it's just very clear, very, you don't have to worry about all that other stuff, and so that's a good thing. Obviously, it does not eliminate the need to follow the home office rules, as to what qualifies as a home office. You need to make sure that it is exclusive use, that it, basically you're not set up in the corner of the family room. They're wanting to see a separate area of the home, a separate room, that you use it regularly, that it is for a trade or business, and it is your principal place of business. So if you have an office away from home, you cannot have a home office. Okay, so that's the home office deduction. Next thing, red flags on the radar. Even though less than 1% of people were actually audited last year, and a lot of those people didn't know that they were audited because they were just pulled, from IRS. They don't contact you every time you're audited. They only contact you if there's a problem, basically. But one of the biggest things is claim 100% business miles. Again, when you talk about miles, we talk about, I'll ask, how many miles did you drive? 15,000. How many total miles? 15,000. Really? That's awesome. I mean, I try and do that. Get a nice, good round number. But it always, ends up being on the 30th of December. I get a nice, good round number, and then my wife will send me off, for New Year's Eve to grab something and screwed everything up. So, obviously, one run to the store is personal use. And so they realize that, especially when you say, this is my own car, that these things are going to tip them off, and it's really not worth the, $5 extra you saved in paying taxes to not do that. So, obviously, that's a big one. Yes.
You ever had anybody audited for mileage or?
I have, I've been part of one audit that was with somebody who had another accountant at the time. So I personally have not had any of my returns audited.
I'm just curious, I know most real estate agents claim if it's not 100%, it's dang close.
And I'm just like, if that's what you want me to put down, I'll put it down. But I will tell, I look at it from the IRS's perspective. I mean, you kind of have to look at these things and say, is there something that really causes a red flag? I mean, if you tell me that this is what it is and you've got proof that that's what it is, I don't have a problem putting it down on paper. But I'm going to tell you, that looks like a red flag. If you want to deal with the IRS, I'm just putting your forewarning on it. Sometimes it's not worth it. I've actually had some clients that will say, you know what, that is probably out of line. It would probably show up, and so let's take off some expenses. I mean, consider it IRS insurance, I guess. So, all right, let's go to the next one. Writing off of hobby loss. They're going to look to see if you have wage income, and then you file a Schedule C with a whole bunch of losses in it.
About real estate.
What's that?
That a hobby loss?
Real estate?
Yeah.
Well, it's not on a Schedule C. Well, I would say if it happens year after year, there could be. I mean, I know I had one, they took, near the end of the year, they took about $20,000 of courses and trainings, week-long trainings. And obviously they're just getting started into real estate. I just threw a note on there so that, I knew it would, when you're showing $24,000 of loss and absolutely no income, it's going to show a red flag. So I throw a little note on there and just explain that this is what it is. And it started in real estate. It took a couple of trainings, and I didn't see anything come back on it. I don't know if anybody actually looked at it, if it was flagged, if it was okayed with that. I don't know, but that's kind of how I do that. Especially if the activity sounds like that.
Can you attach notes like that with your return?
He knows the guy.
I think you can put, there's like a notes sheet you can attach. I mean, I know my software runs it. So. Especially if the activity sounds like a hobby, like dog breeding or car racing or something like that. And that's going to be a red flag. Let's go on to the next one real quick. Deducting rental real estate losses. Obviously, this one might pique a few interest. IRS is actively scrutinizing rental real estate losses, especially those written off by taxpayers who claim to be real estate professionals, and those whose W-2 forms or other non-real estate businesses show lots of income. Now, why is that?
It's cash.
What's that?
It's cash, trying to launder money.
Let's go to the next slide.
That's what I did. That's what you guys do. It's cash.
Which I'll teach you soon. Okay, so first, what is a real estate professional and why would people want or not want to be a real estate professional? First off, you must spend over 50% of your working hours, and that totaling at least 750 hours per year in your activity. Real estate professionals can deduct 100% of their losses. Okay. Most other investors are passive investors, and they can only deduct $25,000.
So can you carry forward the loss to the next year? I mean, if it's $25K a year, you can knock off $100,000 in 4 years.
Yes, you can.
Okay.
But, so those are probably the pros to being a real estate professional. You can, write off everything. What are the things you got to be wary of? Well, you're also going to be giving self-employment taxes as a real estate professional. Whereas with the passive investor, you do not have any self-employment tax on your profits. The other thing with real estate professionals, they kind of take on, houses become inventory, just like a grocer would have cans on a shelf. A real estate professional may have houses on the shelf. And so it kind of becomes your inventory and those types of things. So there are some pros and some cons to being a real estate investor. That is one thing that the IRS is looking at to make sure that things are done properly. Next, running a small business.
Can I make a comment with that?
Yes.
You can't flip-flop from year to year to determine what's the best for you for taxes with that, correct? Or you mind sharing that for a minute?
You cannot flip-flop from year to year. You cannot have your tax And I shared that freely with them. Yeah, I mean, you can't, you kind of, once you become a real estate investor, unless you disqualify yourself because of the qualifications, it's kind of, now you're a real estate professional and you're doing that. So, owners of cash-intensive small businesses, taxis, hair salons, car washes, those types of things. Obviously, it's easy not to report all of your earnings if it's through cash, that type of thing. So going along with that, true or false, if I get paid $450 for some reason as a contractor or whatever, obviously I'm not going to get a 1099 from whoever paid that because it's under the $600 limit. Therefore, do I need to report that $450 on taxes?
No.
True. Yeah, true. You do. Okay.
You don't have to.
So,
It's true that you don't.
anyway,
I was listening to you. It's true that you don't.
okay. So, yes, you need to basically report all of your income. This is what's that? Usually, if a dependent is, there's a limit to when you need to report, when you need to do tax return. Usually, I think it's about $6,000 this year is where that is basically with deductions and things, you don't owe any tax up to that point. And so, you know, just as a side note, I have a lot of clients that have, you know, teenagers just getting into the workforce, you know, that type of thing. I will tell them, tell them to go exempt on the withholdings until they get to about that $6,000 mark. Because up to that point, they are not going to owe any taxes. Once they hit $6,000, you may want to change that so that some withholding is being withheld.
So if you hire your own kids or your spouse up to 6,000, can you pay them that 6,000 at once?
You pay the $6,000 what?
Can you pay them a flat salary for the year, $6,000?
All at once?
All at one time?
Yeah. Yeah, you could. Now, one thing you got to be aware of, though, also is, I should have made it clear, is if there's 6,000, that's if they're not, that's if you're not claiming it. So let's say they're out of high school, maybe just working, that type of thing.
Could you talk a little louder, please?
Yes. Okay, so, all right. So the $6,000 limit is if they are not being claimed on your return. They are going to claim themselves. Does that make sense? Okay.